Hello, everyone. Today on the final bar, I'm talking to Louis Llanes from Wealthnet Investments. We'll talk about some of the charts that tell the story from his perspective of this market environment. We're going to go through as many charts as we can in 30 minutes to try to explain what's happening. You call today sort of a digestion day. If yesterday was the big meal, or probably, to put it very crudely, a big puking out, the opposite maybe of a good meal, but today's the digestion day. Today's where you make sense of things. We recover a little bit, we chop around, but we're still netting out to the downside, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the toolkit of technical analysis, the finest toolkit I've learned over my career to make sense of what's happening, right? I've always talked with my own premium members, with viewers, with clients when I was in different roles in the industry about improving your market awareness, improving your ability to understand what's happening around you as an investor. And if you had a good market awareness so far in 2022, you saw very clear signs of outperformance from the commodity space, places like energy and materials and others doing very, very well. You also saw very clear signs of a negative rotation from some of the growthy stuff that's continued to struggle. So while the movements on individual days, while the moment-to-moment shifts in the markets a lot of times can be unsettling and challenging to pinpoint, the overall trends, I don't want to say have been easy, but they've certainly been fairly straightforward in terms of what happens. And today, we have a great guest, Louis Llanes, who was actually on the show last in January, right after the market top. And we'll talk about how the picture has changed since Louis was on the show last. We have great guests coming through. Again, I'm very excited to talk to Louis Llanes here very shortly. Some of the other guests that we have coming up here, Jay Pettit is joining us on June 2nd. On June 7th, we have Larry Tentarelli. I believe we have John Kosar coming up next week. As always, if you go to StockCharts.com to our live stream page, we'll have an up-to-date list of who's coming up on the show, and also some of other shows like Your Daily Five and elsewhere, where you can get some great expert commentary. Let's continue on with today's show and go to our market recap. Let's try to debrief on what happened in the markets today, and as much as we can, connect the short-term movements of today with the long-term structural movements in these markets. Let's try to make sense of things together. When we look at the major averages today, netting out to the negative side earlier, about an hour ago, as I'm starting to think about the show, the S&P was actually up in the green a little bit, up to 39.40. The NASDAQ was up about 0.5%, if I remember, earlier in the day. By the close, though, all of them settling down. The NASDAQ actually trading more toward the lows of the day, closing just below yesterday's close as well. So the NASDAQ composite down about 0.25%, down 0.6% for the S&P 500, which is now closing right around 3,900, not too far off of yesterday's close. The VIX is back below 30. So again, overall, did the volatility come off a bit today? Yes. Overall, is the volatility reading using the VIX a little more elevated than average? Absolutely. Particularly if you look at the last 6 to 12 months, we're certainly up at the upper end of the range. There's no particular upside bound to the VIX. The VIX could theoretically go a lot higher than it is. It can't go much lower than zero. So you kind of have an idea of where we're at relative to the trend. The chart of the VIX shows how we've overall, in the last 6 weeks for sure, sort of been in that 30 range, which is fairly elevated relative to average readings over time. In terms of interest rates, coming off a bit with the 10-year yields down to 285, 286 going into the close. The dollar index off about 1%. And, the dollar pushed to the upside pretty strongly yesterday as equities were struggling. Risk assets were coming off. The dollar index pulling back a bit yesterday. Overall, the long-term trend has still been fairly robust. That's one of the real key themes, I think, that 2022 has been a stronger dollar. If and when that changes, that could be a bit of a different environment. It might be an interesting chart to watch, particularly if you've been ignoring non-US markets, which I think a lot of investors probably reasonably have done because stronger dollar usually means outside the US, not a great benefit because you're basically losing on the currency exchange. So it's better to stay closer to home. So an important chart to watch for an inflection point. Gold and silver pushing to the upside today with the GLD up about 1.5%. Silver prices up almost 3%. Oil prices doing fine as well, although energy stocks were essentially flat today. Cryptocurrencies, all green in our top 10 most liquid coins that we track on our platform. Bitcoin settling in right around that same level, that 30,000, almost to the penny at 30,000 right now. To the dollar. So, it's interesting to see how, Bitcoin has shifted. It's traded below 30,000 a number of times, now coming back up and testing that level. Big round numbers have often been important for a number of asset classes, but particularly in crypto land. Literally at the moment, we have Bitcoin right at 30,000, Ether right at 2,000. Getting below 2,000 is a bit of a concern because, this is where you expect, buyers and sellers to sort of reevaluate what price level makes sense for something like Ethereum. So it may be important to watch both of those to see how they trade around those sort of big round key levels. Looking at a chart of the S&P 500, it's a downtrend, and we've talked about that for quite some time, right? And I think, and I say that with a little bit of sarcasm, what we've talked about over the last couple of months is just respecting the trend. We've been talking about that since the birth of the show. We've been talking about respecting the trend, following the trends. And as I've told all of you many times, I think your goal as an investor should be threefold. Number one, identify trends. Number two, follow those trends. Number three, have some mechanism to identify or to anticipate when those trends are shifting. If you do those three things, if you ask those three questions every day as an investor, overall, I bet you will probably be on the right side of things more than you're not. And so I would say with something like the S&P, when you have these big spikes, the bear market rally that I think we're just coming off of, in the last couple sessions, just remember that regardless of how sudden or severe one day's movements are, it's all about the trend, right? And the trend is formed of a series of days that are strung together. Look at how the highs and the lows are evolving over time. The S&P is still in the downtrend. I think it's very reasonable to be thinking about downside targets, and I'll leave that the rest of that discussion for my guest after the break, because I know Louis Llanes has some thoughts about how to think about measuring some downside potential for the S&P and the major averages. Looking back at just what happened today, you can see that materials was the number one sector, really the only one above zero with any meaning there, about 0.7% leading the way higher. After that, it was healthcare. Consumer discretionary was way at the bottom of the list, down over 6%, if I remember right, from yesterday. So a nice bounce higher, although it's essentially flat for the day, but outperforming the S&P today. On the downside, you have consumer staples down almost 2%, followed by technology, followed by industrial. Sort of the defensive stuff, sort of pure defense like real estate and utilities, although you could certainly label consumer staples as fairly defensive. REITs and utilities were essentially flat for the day, just down just a touch, but overall, sort of right in that middle ground. It's interesting when you think about the chart of utilities. I love bringing up utilities because I feel like on average, individual investors don't tend to. These are not household names, and certainly not something you would share at a cocktail party. Hey, what do you like right now? Utilities. I mean, it's just not a great discussion topic, as opposed to Meta platforms or PayPal or something like that where there's a theme behind it. Utilities are boring. They tend to be low volatility. They tend to be lower beta, meaning they're less noisy than a growth stock or than more of a choppy mover. These are more slow and steady gainers. But look at the relative strength at the bottom. If you start the clock in November, which is when the NASDAQ peaked out, which is when a lot of the big technology shares peaked out, and that was sort of the end of the run for them. Although the S&P made a new high into year end, a lot of things actually topped out in November. From there on, utilities have actually been a consistent outperformer, particularly when you include the dividend component, which is a big part of the upside for some of these stocks. So while it is not a sexy selection, while this is not what I would call the juice or something that is something to get particularly excited about, I tend to be excited when I own stocks where the relative strength is going up. And I was taught if you want to outperform the S&P 500, you have to own things that are outperforming the S&P 500. That is by definition, right? You cannot outperform if you own things that are underperforming. So in this sort of environment, when it feels like everything is getting crushed, when it feels like everything is going down, and you're just trying to find some opportunities, I would focus on this relative strength line. And what you see with utilities, what you see with some of the staple stocks we've talked about, with energy, with materials names, you find stocks where the relative strength is improving. And in general, if you stick in those places, while you may not have a blowout 2022 on a relative basis, you're certainly going to ride out the noise part of it. You're going to ride out the uncertainty a lot more easily because you're going to be in things that are holding up better than the broader market averages. Just to finish off, I just want to hit, maybe one or two stocks if we have time for it. Target, a lot of the big box retailers are obviously in the news this week, big earnings, and that was one of, I think, the big takeaways so far from this week, where charts like Walmart, Target gapping lower. The problem with the chart like Target, it literally yesterday when it gaps down, I immediately get people writing me and saying, is that it? Is that the capitulation? Is that the low? And two things concern me about. Number one, you can see from days like today, just because it's gone down a lot does not mean it can't keep going, right? I was taught stocks go down for a reason. Prices go down for a reason. And what you want to look for are signs of accumulation, not signs of it going down. And I think that's where you get on Target. The other thing, just to wrap up the market recap, I'm concerned when people see something like Target down that much and are getting excited about buying. They're looking for opportunities. And I'm thinking, that when you stop asking me, that is probably the time you want to think about buying. Let's take a quick commercial break. We'll be back with Louis Llanes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close as we break down these markets using the power of stock charts, using data visualization techniques, the technical toolkit to better quantify investor behavior and increase our market awareness. I want to bring on my guest here in a few moments, Louis Llanes. Before I do so, a couple quick announcements. First off, we love hearing from you, particularly questions. What are you running into as you are trying to use the technical toolkit to understand the markets, to place your bets, to make buy and sell decisions? We're here to help point you in the right direction. We're going to do another mailbag segment on tomorrow's show on Friday of this week. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. Hope to feature one of your questions on our show on Friday. Also, go to stockchartstv.com. That is our on-demand platform. We have so much great content for free every trading day, and even occasionally on the weekends. We just earlier this week did a special version of The Pitch, where Jay Woods, our friend in New York and former executive floor governor for the New York Stock Exchange, moderated a great conversation with three expert panelists, each pitching 5 stock and ETF ideas. You can find that along with all of our previous episodes, all for free at stockchartstv.com, or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Louis Llanes. Louis is the founder and CEO of Wealthnet Investments, coming to us from Colorado. Louis, it's great to see you. You were last on the show in mid-January. What we now know is right after the top. So welcome back.
Oh, it's perfect timing. Yeah, that was wonderful. In fact, I think I said that. Thank you for bringing me on at that time. It's awesome. I love it.
It worked out. So obviously the picture has changed quite a bit since we spoke last. You brought some charts to sort of, help make sense of what's going on now. Talk us through your perspective. What are you seeing here?
Well, the two biggest questions people are asking are, how much further can this market go down? And how am I supposed to invest or trade in this environment? So in 5 minutes, I kind of want to just do a rapid fire on it.
Let's do it.
And hopefully answer those questions. There's basically two basic ways to kind of estimate how far a market can go down. And one would be technical and the other would be fundamental. So I'm going to kind of first start off with the technical side. The first, I'm going to talk about two ways that technicians primarily look at downside targets. One would be a kind of a Fibonacci retracement. And you had a beautiful chart showing that. And your chart actually is a lot prettier than mine. But let me go over the numbers of that. basically, if you look at these retracements from the kind of the reset low from the I call it the pandemic low, basically we're looking at a midpoint right at about 35.20 as being a retracement there. And then if you go down to a 61% or 61.8% retracement, it's roughly about 3,200. So that's a pretty good decline from here. So there's more based on that analysis. There's potential that there could be more downside and relatively significant. If you look at the percentages from the retracement, it's somewhere between say 10 and 20%, something like that. But if you look at it from a head and shoulders pattern, which is the other technical method, so a lot of technicians are coming out and they're saying, look, this is an obvious head and shoulder pattern. If you look at the right side there, we have what's called right translation, which means we had two significant waves where more time is spent going down than going up, which is a different character than what we saw earlier. So, and if you could kind of see the head and shoulders there, that's a very classic pattern. So if you measure from the neckline to the peak, go down from there, that's roughly about 608 points down. That brings you right at about a 35.20. So that, okay, so what is that in terms of percent? Let's just talk, roughly, it's roughly a 10% move. Okay, so that kind of gives a general summation of technical. Now let's look at the fundamental side. Now, we like to look at multiples fundamentally, right? So on average over the last 20 years, we've been trading at about 15.5 times earnings. So if we just went to normal earnings multiples, we'd be roughly at about 36.51. Okay, so 36.51, what is that? That gives you just a slight decline from here, right? We're close to it, 7%, 8%. But if we go into a recession, which by the way is my view that we're in a recession now, and we don't have enough time to talk about why. But if we do that, you'd have to kind of haircut the earnings. And if you just take an average haircut during recessions and you say we have normal multiples, we're sitting at 27.38 on the S&P, which is a big decline. That's a 30%. So I think in reality, we have to have Bayesian thinking. It's somewhere in between there. We don't know for sure, but it's somewhere in between there if we are not already bottoming yet. So, but there's some first principles that you have to think about in a bear market. Volatility is always higher on a daily basis in a bear market. So picking bottoms is very difficult. So being out completely, in my opinion, is the wrong thing to do. So what you want to do, hopefully you already have dry powder. But if you don't, make sure you have some, right? And then if you do have some dry powder, an appropriate amount, to scale your way in. But there's one thing that we know coming out of a bear market, a lot of money is made, right? And what you want to do is you want to pick the leaders on the way out. And there's one most reliable indicator that you could use, and it's what you talked about, and we all talk about its relative strength analysis. So what you want to do is you want to have those good companies, and there's lots of different ways you can come up with that, but good companies that are demonstrating relative strength, positive divergence. And that's just a fancy way of saying it's turning the corner in performance relative to the market. So that is the most reliable way that I know of to pick the high probability best winners coming out of a recession. So I would focus my attention on those types of companies because you never make any money in a market unless the marketplace recognizes your valuation and pushes the price higher.
That is a perfect 5-minute sandwich there, Louis, walking through sort of the big picture. And I really appreciate it. It's so fascinating how the world has changed since you were on the show last, but I love the discussion and marrying sort of the fundamental and the technical together. And also, I know if you could briefly say it, I know you have your podcast going called The Market Call, right?
Mm-hmm. The Market Call Show. Mm-hmm.
That's great. So congrats on that. And I'd encourage people to check it out for sure. Louis Llanes from Wealthnet Investments. Great to see you. Stay safe down there in Colorado. We'll talk to you again soon.
Thanks, Dave.
That's Louis Llanes. Louis is the founder, CEO of Wealthnet Investments, coming to us from Colorado. He hosts a podcast called The Market Call Show, and also is the author of the Financial Freedom Blueprint. It's really well done. He shared with me a copy before it went out, and I was really, really impressed with how it thinks and how it talks about some really straightforward ways to think about your investment portfolio. I love that thinking, by the way. If you hear how he portrayed the market conditions at the very beginning, he talked about marrying the fundamental and the technical. And what I've seen from successful investors I've been able to work with, they find that balance, right? They think about the macroeconomic inputs, they think about the big picture, they think about the fundamentals of a company they're looking at, but they also respect market behavior, and particularly the importance of relative strength. So could not have scripted a better guest to reinforce the value of relative strength investing. Those are great take from Louis Llanes at Wealthnet Investments. Let's continue on with our next segment, which is called Getting Sentimental. Let's update some of the recent market sentiment indicators and see what sort of information we can tell. And I will preview by telling you one of them, really bearish positioning, which we'll talk about here in a few moments on the NAAIM exposure index. So when I look at sentiment, I kind of put it in a couple different buckets. One is looking at volatility. The second is looking at survey data. So we look at the AAII survey and the NAAIM exposure index, which is a survey of positioning, basically how money managers are positioned in the equity space. And then the third piece is looking at the options market and looking at particularly at puts versus calls, what we call the put call ratios. Let's go through each of those very quickly and see what information we can find. I was on an interview yesterday and was asked about the VIX, asked about volatility and essentially how come the market's going down, but the VIX has stalled? Does that mean that the bottom is in? And no. The short answer is no. I don't think you can make that conclusion from it. The main answer in it, and if you watched this show on Thursdays before, and I bring up the chart of the VIX, I usually explain what I call volatility regimes. I think of it as, the VIX tends to settle into a certain range, and that's sort of the range for that window of time. And then eventually it will change, right? You'll get out of that, and you have a period of higher volatility and lower volatility, and really understanding when the regime is changing is vital, because then you can see how things reset and sort of settle into a new range. If you look in 2021 was actually a fairly low volatility year. After the first quarter, which is still kind of noisy, as we resolved out of that consolidation pattern in late 2020, November, we made a new high for the S&P. We pushed higher into year end. After the first quarter of 2021, we sort of settled into a fairly low VIX relative to where it had been. It was between around 15 on the low, around about 20 to 25 on the upper end, because this was this nice, slow, steady gain, right? Just this consistent uptrend through most of last year. The game there was just to sort of ride winners and continue to push, follow these the uptrends as they led the market to the upside. Look at how things shifted, though. When we talk about how the market changed, starting in November, I think November, December into January is when the character of the market changed. That's when breadth indicators rolled over, momentum indicators rolled over. That's when a lot of growth stocks topped out. And even though the S&P went higher, a lot of things started to deteriorate going into year end. And you can see that where the volatility all of a sudden spikes. Instead of finding resistance at 25, it pounds up to 30. Now we've seen that the VIX being around 30, 35 is where we've had dips in the market that have overall been bounces. But instead of being buyable dips, instead of being 2021, where it's a super easy year now in the rearview mirror, where all you need to do is just wait for the pullback and keep buying those dips, all of a sudden buying on the dips is a pretty miserable strategy in 2022. If you're a tactical investor, if you're a swing trader and just betting on short-term mean reversion, you've probably done okay. But if you're a longer-term investor, buying on the dips has been pretty painful, because all you keep doing is adding to a losing portfolio and continuing to add more exposure to the downside of the market. So the fact that the volatility regime has changed has been key. So where are we at right now? Well, we're right around 30, which is pretty much where we've been for the last 3 or 4 weeks. So what can happen when the market sort of settles into a downtrend, which is what it's done now? Volatility can become elevated and just kind of remain elevated, right? It can sort of remain at the upper end of that range. That's why when the VIX hits 30, I'm not screaming, okay, that's obviously a tradable bounce. That's where we need to start buying, because when the market deteriorates, you can get the volatility increasing because people overall are fearful and they're taking action in their portfolio, really motivated by their fear. Chart number 2, the AAII survey. This is the American Association of Individual Investors. No real change from last week, so not a big movement. Bears still outnumber bulls by about a 2-to-1 ratio. The spread between the two is about 25%. And overall, that's about where we've been through most of 2022. We had a couple weeks where we had a very even spread. This is on the bounce in March, which got a bunch of people believing that the S&P was going to blow through 4,600 on the way to 5,000 or 6,000. That obviously did not play out, right? We immediately rolled over again, and we have negative sentiment. So no real change there. And again, no real change is not a good sign. That tells you that there's more of a despondent feel to the survey recipient and respondents there. Next one is an important one to watch. This is the NAAIM Exposure Index, the National Association of Active Investment Managers. Participants in this survey are asked, what is your exposure to equities, right? How are you allocated? And you can be 100%, 200%, 0%, and even short. This is at another low. So last week we had a big gap from almost 60% to just around 20%. This week we actually went below 20%. We've only been below 20% a couple times in the last 6 or 7 years. Once at the March, going into the March 2020 low, that is, and the second time in mid-March 2015. Now, before you get super excited and say, great, that means we're at a bottom. In our 3 and 3, I feature a longer version of this chart, and you'll see why I'm not super excited about that as a potential bet. The bottom series, by the way, is the RIDEX flows. This is something that our friends at Decision Point, Aaron and Carl Swenlin, look at pretty regularly. That's where I first learned about this ratio on StockCharts and started following it. This basically says, are investors in the RIDEX family of funds in the more bullishly positioned things like long equity or sector funds, or are they in more of the bearish, the cash and cash-like money market types of places? It was at an all-time high here in late 2021, November, December. It was all in. Investors were in the most bullish positioning they had been going back through the data series. Turns out that was a pretty good time to bet on the opposite. From there, we've seen an overall average deterioration. We're continuing to see basically an increase in that value. This is plotted inversely, which shows you that investors are more and more getting defensive. Now, we're not anywhere near the levels of defensive positioning we've been at major bottoms. We'll just finish with the put call ratios. I'm not finding overall a ton of value in these versus what I'm already seeing with the VIX and what I'm seeing with some of the positioning data. So I don't want to spend much more on that, only to say that the put call ratios overall are fairly elevated. I plot these in pink, which is the 5-day moving average of the raw data, because the raw data is actually every day and it's pretty noisy. But if you look at the green in the background, you can see that overall it's been fairly elevated, meaning that options investors are very much on that side of it. Now, again, before you get too excited about that, in deeper corrections, the put call ratios have certainly gone much further than what we've already seen today. That's our segment, Getting Sentimental, focusing on some of the weekly sentiment data. We need to wrap the show, folks, and go to the 3 and 3. Let's talk through 3 charts that tell the story of this market in just under 3 minutes. And here we go. Chart number 1 is the new Dow theory. I feel like I've brought this up a number of times, and here's the reason. Anytime I've been doing an interview where I've been asked about the market, and I always get asked some question about, where is the bottom and did it just happen, in some form of that question. And my response is to bring up charts like this and say, and especially when you have the big bounce like we did earlier this week, and people say, okay, was that it? Is that like the big move higher? And my response is, as a swing trader, like maybe that's a great opportunity to bet on short-term strength. But overall, the trend has been undeniably negative. You heard Louis Llanes, so I thought had some great thoughts about downside projections using technical disciplines and also some fundamental ideas, thinking about multiples, thinking about valuations. But overall, the trend is down, right? The S&P is making new lows. The NASDAQ is making new lows. I will get excited when that stops happening, but we're not seeing it yet. Chart number 2 is the NAAIM Exposure Index. This is looking at where we're at in terms of the survey data, how exposed are money managers to the equity universe, currently around just below 20%. If you look back, that has not happened very often. And here's the problem. It happened in early 2020. We actually didn't get this low in 2018. We did get this low in the third quarter of 2015. Here's the problem. In 2011, we got below 0% exposed to equities. In 2008, we went below 0. In 2007, we went below 0. So in extended downtrends, you will see those lines revert below the 0 line. We're not there yet, potentially. Finally, the chart of Apple. What a beautiful illustration of the benefit of technical analysis, recognizing a level of resistance in the second half of 2021 that becomes a clearly defined level of support in 2022 with lows in February and lows in March, breaking that in May, now retesting that resistance level or that support level from below, hitting resistance at 150 and rotating lower. This is a classic technical pattern of a breakdown, a retest, and then the real deterioration happens. Apple making a new relative low yet again today. Folks, that is our show for today. I want to thank Louis Llanes from Wealthnet Investments in Colorado joining us today and sharing some of his opinion. All of our previous discussions and interviews at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.